Welcome to the February Robinson Edge video. I'm Matt Leo and joined as always by Ryan Hammett to discuss the latest developments in global freight market. Today we will cover the Suez Canal starting to open back up again, the new CDL rule by the US government, as well as some of the recent tariff and trade deals. Ryan, let's start off with the Suez Canal situation. We're beginning to see selective returns to Suez routings instead of diverting around the Cape of Good Hope, but it's not at full capacity yet, right?
Correct. Two of the largest ocean carriers have begun testing the waters via the Suez Canal on certain lanes. And yes, Matt, that pun of testing the waters was actually intended there. This route has been largely avoided since 2023. So this is a significant development because routing around the Cape of Good Hope adds roughly 10 to 14 days to transit times. It increases fuel burn, and ultimately it ties up vessel capacity. If the Suez stabilizes, even partially, it changes the math on transit reliability and effective global capacity. When vessels detoured around the Cape, it didn't just lengthen transit times, it absorbed fleet supply as more ships were required to maintain those weekly service strings. That artificially tightened capacity and supported rates. So a gradual return to Suez effectively adds capacity back into the system without building a single ship. But the key word here is gradual. Steamship lines aren't just flipping a switch overnight.
Right. The risk remains, and beyond just the security concerns, insurance costs and geopolitical stability all influence whether carriers fully commit. So what we're really watching for is consistency. If the Suez remains viable for an extended period of time, you could see schedule reliability improve and some softening of pressure on long-haul ocean rates, especially in the Asia to Europe and potentially even the Asia to US East Coast lanes.
And that has downstream implications for North American supply chains. More predictable arrival windows reduces port bunching, which helps drayage, warehouse throughput, and even domestic truckload capacity. But I'd caution shippers against assuming immediate relief. Networks take time to rebalance. Even with the Suez reopening, carriers are still managing blank sailings and capacity discipline. So it's less about a sudden rate drop and more about reduced volatility if this stability holds.
Now let's pivot to the new CDL ruling finalized February 13th and going live on March 16th. Under the finalized rule, eligibility for the new issuance or renewal is now limited to H-2A, H-2B, and E-2 visa holders, meaning that the temporary protected status, or TPS, which are those granted to nationals of designated countries due to armed conflict or disaster, as well as DACA, which is deferred action for childhood arrivals, are now ineligible for renewing their CDLs. Now, one thing to keep in mind is that this just prevents these groups from renewing their CDL. It does not revoke that CDL. Federal investigations revealed that most non-domiciled CDLs were issued with 5 years of validity, which means that a large shock to supply is not expected, but rather a long, gradual pace of attrition as these CDLs come up for renewal.
Yeah, that 5-year renewal cycle is critical here. Depending on when a license was issued, the exit effect could stretch across multiple years. During that time, drivers may be able to requalify for a CDL, maybe under other visa programs, or even resolve their immigration status. And the broader market context matters. While we have definitely seen tightening in the truckload marketplace, we're not at a point of being undersupplied. The truckload market tends to search for balance. So if capacity exits gradually, that could create space for new entrants if rates improve. The US carrier base is very resilient, more so than it gets credit for. So the question is, how much capacity is expected to be removed in total over these 5 years?
Yeah, that's a good point. And the headline number that caught attention was the DOT estimate that about 194,000 non-domiciled CDLs could be impacted. But that number needs context. That figure includes all CDL holders, like bus drivers, dump truck operators, drivers in private fleets, straight trucks, or even inactive holders who maintain a CDL,
Right.
don't actually actively use it. Ultimately, there's not 194,000 active Class 8 for hire drivers that will be affected. Now, combining that with the 5-year phase out period that you mentioned, it will mitigate the impact significantly.
We should also remember this isn't happening in isolation. We do have cumulative regulatory pressure. English language proficiency enforcement, which is taking drivers out of the market, the modernization of FMCSA registration processes, which resulting in higher denial rates, thus limiting the new entrants, broader ICE enforcement, rising insurance scrutiny, and potential EPA 2027 cost increases that could add more than $20,000 per truck. Individually, each may feel small, but collectively, they tighten the system over time. So, in the short term, regulatory announcements can act like a mini check week. There's uncertainty, some temporary pullback, and some volatility, but the finalization of this non domiciled CDL rule actually adds clarity. Markets prefer certainty over ambiguity. And because the implementation is phased, we see the impact as measured rather than disruptive.
Now let's move on to our final topic of trade. February brings several updates that are expected to impact various industries. And tariff shifts and new trade agreements are creating a more complex sourcing environment. Some tariff relief measures are extending exclusions on select goods, while other categories face tightened environment and scrutiny.
Retail is especially sensitive here. Retail margins are tight, and tariff adjustments can swing total landed costs significantly. Many retailers are continuing diversification strategies, leaning into Southeast Asia, Mexico, and nearshoring models to reduce China dependency. But that transition isn't linear. Each shift changes freight flows, port pairings, and mode mix.
Automotive is another major pressure point. Rules under the origin of USMCA remain central, and any tariff or compliance adjustments ripple through cross-border supply chains. Because automotive tends to be high volume and time-sensitive freight, so even small customs disruptions create production delays, which immediately affect truckload and cross-border capacity demand.
The energy and healthcare industries also bring trade nuance. Energy equipment and materials often move project-based and are sensitive to tariff cost structures. Healthcare, meanwhile, depends on regulatory precision and supply chain continuity. If customs enforcements tighten or documentation requirements increase, that can slow inbound medical equipment or pharmaceutical inputs. These aren't just trade policy stories, they're also freight stories.
Now, the overarching theme here is that trade policy is not background noise. It
Mm.
directly shapes freight demand patterns. And shippers that integrate customs strategy with transportation strategy are better positioned. Waiting until duties change to adjust logistics usually means higher cost and reactive moves.
Exactly. And we're seeing companies scenario plan more aggressively. I've had multiple conversations with companies using digital twin capabilities solely to run full scale scenarios to have data to answer multiple questions. What if tariffs rise? What if they're reduced? What if sourcing shifts from Asia to North America? Each answer reshapes trucking lanes, ocean demand, air utilization, and cross border flows. The most resilient supply chains are designing flexibility in advance.
So, as we wrap up, across new ocean routings, CDL regulation, and trade policy, one theme stands out: adjustment without shock.
Hmm.
None of these changes individually flips the market overnight, but together they influence balance. The ocean market is watching route normalization, truckload is gradually absorbing regulatory tightening, and trade flows are adapting to policy shifts. It's not chaos, it's just recalibration.
And recalibration rewards preparedness. Whether it's booking early on ocean, monitoring exposure in your carrier base, or aligning trade and transportation planning, proactive strategy wins. The freight market always searches for balance. The question isn't whether it will adjust, it's who is prepared to adjust with it. Make sure you partner with your C.H. Robinson account team on what your next steps are. And remember, C.H. Robinson goes further than anyone else in providing you with the edge you need to manage your complex global transportation strategy. For more details and additional content, reference the Insights page on our website.